Daniel, let's actually start off with that platinum price. We're seeing it up around 1.25% or so. Anything that is driving the likes of platinum at this point? We know the car makers in Europe, in terms of what we're seeing on the equity markets, rallying significantly. We know that production has started to resume in Japan as well. Could this be a natural boost for platinum?
Yeah, I think what's happening for platinum is it's running as part of this wider story for precious metals. So the data out today showed that inflation in the OECD countries reached a 27-month high, and people are looking for some inflation protection, so platinum is included within that basket. The other thing, as you say, is there has been a bit more confidence about the auto sector within China, so some of those plants have been restarting in recent days, and of course platinum is quite leveraged to the auto sector, so that's improving some confidence around the market from that perspective. And the final thing is, as well, compared to its sister metal palladium, investor inflows into platinum have actually been quite strong, whereas palladium investors have been selling fairly heavily. So we have this view at this point that platinum will outperform palladium, and it should do well as well within this kind of auto recovery story.
Let's delve into the copper markets at this point. I would say market participants relatively divided as to whether we're going to see a deficit this year. We know that copper inventories in China also rising significantly as well. What are you reading into the story? We're sitting with a copper price of around $9,520 a ton.
Yeah, there's kind of one major bearish factor for copper at the moment, and that's this continued talk about very high inventories in China. So from our estimates, we think that inventories have risen by about 30% in March in Shanghai, and a lot of this is being consumed with is going into financing deals rather than being consumed by local fabricators. So this is, of course, potentially bad news for the medium-term outlook for copper. The other problem is that local demand is really quite soft in China at the moment, so this is why there's this opportunity to lock up metal within financing deals. So it's a reflection, one, of potential problems for the future, and two, the fact that local demand is not that hot at the moment. So this is the main bearish factor for copper at this point. The main bullish factor is we saw some quite strong data out of Chile this afternoon, strong in terms of bullish for copper. So Chilean mine output was actually down by a very sharp 7% in February, and that's actually the worst data since 2005. So the market's ignoring that for now, but I think that will be a very bullish factor for copper as we go through the next few months.
Well, Daniel, we're around 6% down from the all-time high hit on the copper price, which was around $10,190 a ton. Any chance that we could breach that? I know you were talking about bearish versus bullish factors. Where are you putting your money right now?
Well, at the moment we're recommending a modest kind of short position on copper. We think it'll be fairly choppy and sideways over the next few weeks, but has the potential to test the bottom of the recent ranges, maybe down into the low 9,000s. But we do think it's a good bullish story from a medium-term perspective, so we'd still recommend people to buy the dips on copper. We still think there'll be those supply shortages through most of this year, and as long as China continues to grow, then we think it will be a good long-run story for prices.
Silver's also been a very interesting play. We saw the CME coming in, and it's done so regularly, increasing its margins on silver. We also have a strike at a very big mine in Bolivia as well. In terms of supply constraints coming to the fore on the back of this strike, what kind of impact could it have on the silver price? And do you think we could see a silver level of $40 an ounce soon?
Yeah, I mean, silver's been a huge outperformer really within the complex in the last few weeks and months, and we think that can continue for a little bit longer. So from a technical perspective, we've been arguing for some time that silver will target $40 an ounce. We're not too far off that level now, and speculative interest within silver remains very, very strong. So the ETF flows were up by nearly 4% in March. That was much stronger than any of the other precious metals. But we are concerned that silver is in something of a bubble. So if you look at silver on a ratio basis, it's around about 40% below its normal ratio compared to gold. So this is a significant warning signal that silver may well pull back sharply at some point, but we think it may have more upside in the next week or two.
So in other words, you're going short in the long term, but for now you are going to be long in the short term. No, short in the long term, and perhaps looking to sell some silver right now. Is that what you're looking at, Dan?
Well, yeah, I mean, I'd look for another short-term spike and then probably a pullback in the second half of this year. Of course, within these bubbles, it's very difficult to pick the exact timing, but I think silver is quite a high-risk play at this point, it has to be said.
When you look at gold, which has also been a very interesting play over the last couple of days, it seems that it's set in stone that Jean-Claude Trichet will be hiking rates in the Eurozone. What kind of impact are you expecting this to have on the yellow metal?
Well, we tend to think that rate hikes will slow down the growth in gold in terms of prices, but we don't think it will be, will necessarily derail the rally. That's how we see things. So the main thing for us is the fact that China and India continue to grow very well. Those two key consuming countries now account for just over 50% of global gold demand. And as long as inflation keeps rising, those two countries will keep buying gold in significant volumes, we think. And those kind of factors will overpower, really, we think, higher rates for gold. So we remain pretty bullish on gold. It'll probably be slow and steady upwards, but no reason why we can't see higher prices in the next few weeks and months.